here. I actually spend my summers on Hvar, and that's why I said I want to get to know the Split ecosystem, the startup ecosystem. As mentioned already, so I'm a general partner at Silicon Gardens Fund. Silicon Gardens Fund is actually, I think, the only regional fund which is founders for founders. What that means is that us founders that already had successful exits or have built successful companies, we now invest back into the new generation of entrepreneurs. So, and in May, we actually launched the third fund already, which is a 30 million fund focusing on high-tech companies, very early stage, so pre-seed and seed, and try to help them get to the Series A and to the later stages. So today, how I actually imagine this presentation is it's split in 3 parts. So one is a little bit of a story into Silicon Gardens, how it came to be. Then second, a little bit of a sort of brief history of my personal development, which might be interesting for a younger audience. So also when you're deciding what to do next, when you're studying and when you're starting your first job. And the third one, I picked the Sportradar growth. I don't know how many of you have heard of this company, Sportradar. Anybody? One, okay. So yeah, Sportradar is actually an interesting company dealing with sport data, collecting sport data and selling it to bookmakers and media companies. And it's interesting that not a lot of people actually know that these type of companies actually exist and what they're good for, right? So we're going to look a little bit into the how fast a company can grow and what we actually also expect from our companies that we invest in. So as mentioned first, Silicon Gardens actually started 15 years ago as a community. So us tech founders from Slovenia, we started gathering like that. We had a place called Pipa, where we actually organized meetups so that we could share knowledge and networking and so on. And we started with a philosophy that sort of stuck from there on, which we call give first. So basically that type of philosophy is that whenever you can help somebody, you do that without actually expecting anything back, right? And that's interesting when you sort of look at it long term now, 15 years back, this sort of stuck with the whole community so that everybody that received some sort of help is now helping forward, and that actually goes on and on and on. And we have beautiful stories of how founders of startups got help from the community, built a successful company, and are now in a position, in a much better position to actually help the next generation. And 10 years ago, so it wasn't recent, it was 10 years ago, 2013, it was actually before I exited Sportradar, that we started investing in startups. So in the community, we saw a lot of interesting founders, interesting stories, and we said, why don't we start investing, right? And I think it was Hugo Petkovic who was the first who sold his company, Mimo Vrsta, at that time, and he sort of was the initial push. Behind that, it was a micro fund, like 300K, so not a lot of money. We actually also got help from Fred Wilson and the US investors. And they gave us confidence to actually say, look, if you're not going to do it, who else will, right? So you're in the right position, you know who else is building something interesting, you know the people, and you can start investing. Now, of course, looking back, in nowadays, you cannot do anything with such a small fund. Even with a 5 million fund, you cannot do a lot. Things have changed. Startups need a lot more money. But that's sort of the whole ecosystem actually has grown from there. And we're proud investors. So I only mentioned a couple. There's now 40, 45 investments that we did across all 3 funds. Maybe interesting for you guys, I can go a little bit deeper into what these companies do, if you guys are interested. So we invested in Flaviar, which is sort of a spirits community. So community that actually, through which you can actually, buy spirits and experiment, try new spirits and so on. So it's sort of like a club membership subscription type of a business. It was built by Hugo Petkovic and Grisha Shoba and is now valued at around 300 million. So we actually invested quite early and did a secondary exit 2 years ago or last year, I forgot. And we did a 25 times return. We also invested, for example, in CleanShelp. So this was a company that was founded by an ex-VP of engineering of Zemanta, who was another local startup. And he identified a big need of, that SaaS is going to be a big cost for bigger companies, right? So looking now, it's very obvious, but when he started, it wasn't as much. So basically, he built a SaaS company for managing that SaaS cost, right? And he also sold it 3 years ago to another company, and this is now part of their product portfolio. BirdBuddy is a smart bird feeder. Sounds, like very easy idea. Like, so you have a camera, you put it in so it's in a shape of a bird feeder, you put seeds in, and then basically that one detects birds, and it sends you push notifications as soon as you get a visitor, right? And of course, it also detects the visitor, and there's tons of other stuff that it does. It was interesting, now looking back. So in the first 2 years, the company did 20 million of revenues in just the first 2 years. And now in the third year, they plan to do 50 million revenue. So really nice growth. Also, the valuation is growing nicely with follow-on investments and so on. And that's maybe one point that I could emphasize is how you guys can actually really validate your ideas. Is that how we worked with BirdBuddy in the beginning. When the founders came to us with the idea, we said, okay, let's put a landing page on, and let's start advertising, and let's see how costly it is to get an email, right? And they did that experiment, and it actually was proven that they are 10 times better than the average, so performing really well. And then the next test, we said, well, why don't we actually do a follow-on step and actually ask them for a credit swipe, right? So credit card swipe. So basically, how many people would actually really buy this, right? So with the price, everything, as if you could buy it, just that when you did that, when you purchased, you got I'm sorry, we're not yet ready, right? And we also saw 10 times better results. And on the back of that, we then invested. The guys then did a 5 million Kickstarter campaign, which was a record in the gadgets category. So it was the biggest in the world. And now, growing very nicely. Also, they attracted the follow-on VCs, are really top-notch VCs from US that invested in the company. Juicy Marbles is also an interesting company. I was talking to somebody before saying, in what type of companies we invest in and in which type of companies we don't. So usually we don't invest in production, right? So, but these guys, they produce steaks, plant-based steaks. So they're made out of soy, and they're like filet mignons. You get filet mignons that you can prepare as normal as you would a normal steak. They taste similarly. They have texture that's similar to that. And again, we recognize the really interesting technology. So it's not just production. It's actually a very interesting technology. And we knew, of course, the founders from the ecosystem and invested. Then I'm just going to do 2 more because they're from Croatia. How many of you know 57 Hours? Yeah, okay, a couple. So 57 Hours was actually founded by Victor, who was a founder of Five. And when he exited, he already had this idea that each, something that what we like to call like a passion project, right? And he actually started, with a team that he knew from before. And basically what they're doing is a marketplace between people that are looking for exciting new adventures and guides that can actually do that, organize that. They're focused, on a very, high level, so they want to be like Patagonia for travel, right? And they're executing really nicely, growing month by month nicely. So you can really see when a senior founder with an exceptional team, when they start executing. And Tourneo is actually a company that's also focusing on tourism, basically doing like a digital concierge. So for hotels, for even if you have other tourists, if you're interested in doing some other activities around the locally, you could either ask in a hotel, but in this case, you could actually just see what is available through an app. You book through an app. It basically help the hotels sell more of that without actually using any effort on their side. So I'm just going a little bit deeper into these stories so that if you guys are building anything similar like that, or if you know somebody that is building something similar, something ambitious, do let us know. We're here to help. We're here to sort of try and be there, not just with the money, but also with advice. And we still use the Silicon Gardens community as sort of a way to connect different founders with the people that are sort of maybe one step ahead of them, so that they can help them with the next step, or that maybe they're in the same area, same industry, same technology, and then we do these connections, because in that way the knowledge can actually spread throughout the whole region. So we started in Slovenia, but now we're investing in Croatia and in Serbia as well. So I mean the whole Adriatic region, and also the investors in the fund are also from Croatia, from Serbia. So, well, you'll see a little bit later. Another thing that we do is every year we prepare a State of Adria Tech report. One, because we'd like to see the heartbeat of the community, but on the other side also to attract foreign investment into the ecosystem. So you will see now, on the back of some of the numbers, you will see 21-22 was a very strong year. And you'd see that there's 82% of the old invested capital comes from outside of the region, right? So we still rely a lot, on the, especially later rounds, we rely on the foreign funds, and that's why we need to also promote what's going on in this region, because otherwise when you talk to a German fund or an American fund, this is like a black hole, so nobody really knows what's happening in this, right? And we try to fix that. And on top of that, so I also included some of the top line numbers for you guys. I don't know whether you've seen these numbers before or not. In the last 2 years, there was 3.5 billion euros of investments in the whole region. And looking that in perspective, that is 12 times more than 5 years ago, right? So 30 million 5 years ago, and now comparing to that, it's it's very, very nice growth. Of course, we need to think about that these were exceptional years. So already we see a lot of decline. So we see that there's, especially later stages, it's harder to get money. It's harder to attract American funds into Europe even, right? The other thing that's important for us, and these are sort of usually the information that are not public, and they're sort of entrusted to us because we are part of this community, because we know all these founders. We try to collect it because at the end of the day, for us investors, this is what matters, not collecting investments, but actually exits, right? And if we look at the region, so 5 years ago, even 6, 7, we actually got our first unicorn, Outfit 7. It's a Slovene company doing a mobile app that was sold for $1 billion. Plus there were a couple, so it was a little bit more than 1 billion, a couple of other exits that happened up until that point. Now looking at it now, but this is end of 2002, so this does not include Photomat, for example, and a couple of other exits. These now increased to almost five times more. So, and we also have 6 unicorns, so apart from Outfit 7, we also have Sportradar, Outbrain, HTTP Pool, Infobip and Remats. So, and we can be very proud that these are sort of the companies that are here locally, and can say that these are sort of the unicorns that are growing in the region. Why this is important? Because a lot of these companies are then giving back, helping the community, helping other founders, doing some trainings and stuff. So that's why it's really important. Interesting fact also is that out of that number, 85% is by Slovene founders. And that's sort of just a factor of timing. So we see that now Croatia will also follow. So there was a big growth in investments, and we expect that in the next couple of years there's going to be more and more exits here in the future. And it's really good because we see, so these are some of the companies that did complete exits or some secondaries. It's great because these exits were actually spread across a number of companies and also across a number of people. So that's something that we also give out as an information for founders when you're talking to your employees, how stock options are important, right? So Outfit 7, for example, it had, I think, 7 or 8 founders. But with that exit, there is now 20 millionaires that came out of that exit. So meaning that there's lots of people, key employees, that got stock options and now are millionaires out of that. So it's not necessary that you need to start a company. You can also join in an early stage or be, key employee, and you can also earn a lot of money. Sportradar, for example, if you look at my company, Klika, so we were 4 founders. And then when we joined Sportradar, there were 3 other founders. And out of that, also around 15 out of Slovenia, 3 additional key employees also became millionaires because of that. And Nice Label, I think, also was 1 founder, but at the end of the day, 5 Slovenes and 5 people from outside Slovenia that also had key positions and also became millionaires. So that's interesting also because all these people now are investors in Silicon Garden. So all these key employees or founders, even guys from Photomat now and Five and Microblink are joining, and on top of that also some of the investments that we did, like Flaviar, Clean Shelf and BirdBuddy, these guys also joined in the next round. And that's what we keep saying, that this is like a flywheel that's happening. So that more and more companies that we invest in, become successful, they exit, and then they invest back into the ecosystem. By the way, I didn't mention it before, but of course, if you have any questions, just let me know, because I like to keep it sort of intimate, so just interrupt me. And our mission, as I mentioned in the beginning, is that basically we want to help the next generation of ambitious entrepreneurs build even bigger stories, right? And here I would stress the ambitious part, right? So we actually are quite picky with the investments. So we want to see unicorn potential. We want to see really companies that can scale, that can actually be global leaders. We want to see this type of ambition in local founders. And we're hoping that with our stories, we can show that this is possible. You can do that, right? The other thing is the Silicon Gardens community, as I mentioned. So it's organized as a Slack channel or Slack community. Initially, it started as a very exclusive community. So we basically invited only top startup founders. But now we actually open doors to anybody that's dealing anything with startups, and we try to connect people with the right in the right stages, and people in the same industry or using the same tech, so that you guys can then help each other, right? And at one point you might be receiving help, but on the other side you will for sure get to a position where you can also help others. So this is a QR code. I'm going to also have another one at the end of the presentation. Do register, and then there's a questionnaire. Just fill it up and you'll get invited to the community. So the second part is what I mentioned is maybe interesting for the younger audience, right? So maybe what's interesting for a lot of people that know me now is that I didn't study economics or business. I studied computer science. And I'm a computer engineer by education. And I actually started working in the first year of the local university. And sort of I got interested into building the first sort of like a spin out of Hermes Soft Lab. So I don't know whether you know this company. So it's this in Slovenia. It's a very well-known company. It was almost 1,000 employees at one point, even with offices in Belgrade and in Bosnia. And so they had this idea that they would do a product. And I just happened to be at the right place. And I said, well, Gregor, you and two other students, why don't you start building that? And this was me in the first year of university, part-time doing that, right? And that part-time turned into full-time. I still managed to finish the university, even working full-time at that business. We grew the company to about 45 people, but unfortunately we closed doors in 2003, and it was merged back into Hermes Softlab because the partner Eurologic had issues. The whole economy burst, the bubble burst, and it was really hard to continue. So, and at that point I was more in the engineering role than in a business role. So, but I learned a lot through that experience. And that's sort of the maybe first sort of guiding point for younger generation is that you don't need to start your own company as a first try, because if I would do something like a local idea, who knows where I would end up. I actually started with something that I didn't have the knowledge that this was like in storage, that there's some potential for a certain product, but started on a very global idea. So so from the start we had this global ambition that us, initially a very small team, students out of Ljubljana, could actually challenge HP and IBM and companies like that. So, and that's very important, very valuable lesson that you don't get stuck with these smaller ideas which have don't have that much potential, but you can see that you can actually regionally also start bigger high-tech companies. Even at the end, maybe it didn't succeed, but you learn a lot from that, and it gives you sort of that confidence that you can actually do a lot on a global stage. And another good thing happened from Sourcescape, which was that I assembled my team at that company, and we started Klika, which is now I call it like an external innovation lab. So looking back, we actually, because we're all engineers, love technology, loved playing with new technology, we rode all these interesting waves that happened. So transition to mobile, to cloud. When we started, it was even developing software for servers, right? So still on-premise. There was no cloud at that point, right? And then at one point, it became, well, not very clear, but it became clearer that things are moving to the mobile and to the cloud. And because we love the technology, we were, of course, the first in the region to do something like that. And also all the following waves that happened because, on the back of that. And then what I'll tell a little bit later is that we started working with a company called Sportradar, which is a sport data provider. And so because we worked in a little bit of a different way, we never liked that we would just get a project and say, do this, right? So we always talked with the partner, looked at their business, combined that with our knowledge for technology, and then basically saw how we can actually continue, right? So in a lot of cases, we minimized the work. So we looked at, what can be done at a minimum expense, at a minimum effort, to basically validate the next ideas, and then go forward from there. And Sportradar actually at that point, sort of, I could say, fell in love with us, and they said, well, you guys, you need to join the team, and that's why they invited us to join the founding team. In 2011, we actually finalized that merger. In 2018, I actually exited Sportradar, sold my share, which I'll tell a little bit very later through the growth story. And as I mentioned before, we started already 3 funds, so one in 2013. The other one started after our exit and after Outfit 7 exit. So that was in 2019. That was a 6 million fund. And now, just recently, we started a 30 million fund and can actually invest, starting from tickets from 200K, even up to a couple of million. So following that, that investment.
Are the results of the funds public?
Well, not. They're public to, of course, to investors, but I can share it here. So the first funds, so of course you need to understand that these funds are usually invested for 10 plus 2 years, right? So because investing into a company, it's not just risky, but it's looking at it from a liquidity perspective, it's a very illiquid investment, because you invest, you cannot really sell it, and you need to wait and help the company really grow until you have an opportunity to sell, right? So I can say, for example, for the first fund that we started almost 10 years ago, now it's at 2.5 times return. So basically we invested, so we did 3 exits, Clean Shelf, Flaviar, and Povio, that actually did together, 2.5 times. And there's 2 other very strong companies that we expect that are going to do additional 2 times. So it's interesting when you look at, so we did 10 investments, and out of 10 investments, we expect there's going to be 5 that are going to actually exit, which is it's not a typical case. So usually you see this very strong power law, which means that, one investment is going to really, return the funds, hopefully multiple times, and that's going to be the majority of the profit. Then there's going to be a couple of other investments that are going to do a good return, some that are going to do very neutral, and then a lot of things that, unfortunately they're not going to do a lot. So that's called the power law, and that's why it's always important, even if you're sort of investing as angel investing, the trick is that you need to have a very big portfolio, right? And you also need to spend a lot of time doing the due diligence, getting to know the founders, because founders are key. At these stages, these are the only things that matter. If the idea is not good, or if the market is not good, if the founders are good, they're going to pivot into something better, right? And find better opportunities. I hope that answers your question. Yeah.
Do you only do investments in areas that you and the people in Silicon Gardens can do diligence themselves, or in genres that are new for you, businesses that?
So mostly yes. So we actually do try and focus on the stuff that us and our LPs are actually focused on, or have knowledge and expertise. We also, of course, involve our LPs. So LP means investors, for you that don't know. We also include them into the due diligence and also the follow-on help, whenever they can. But that, of course, didn't stop us from investing into some of the companies. Like, for example, none of us have built a hardware company before, and we invested in BirdBuddy, and we're quite happy with that so far. Nobody knows what will happen at the end, but so far the results are promising. Also, we never really dealt with food production, but we invested in juicy marbles. So there are, sort of exceptions to the rule, but mostly what we like to invest is, so on one side, I like the B2B SaaS model. So enterprise sales, or any type of, sort of a SaaS subscription, monthly subscription type of a business. And my other partner in the fund is Rok Zorko, who is a co-founder of Outfit 7, and he focuses more on the consumer type of businesses. So we also have a number of investments that are mobile apps, subscription apps, they're actually selling to the consumers. That's again a very specific, a very, sort of risky area, but because we know, we have the knowledge, we can actually do that, right?
Can I have a follow-up?
Sure.
So what was the thing that actually made you invest in something that you were not common in? Was it like the team? Was it good on financials, or was it the idea great?
So in most cases, of course, it's the team. So that's, I would say, number one. So the company makes or breaks on the team, right? So, and that's why I'm saying the founders need to be ambitious. If they're not ambitious from the beginning, targeting, I don't know, IPO or like building a very big company, then, it's a very low chance that they will actually do that, right? The other thing, of course, is that there's some things that are sort of in common, like, how can you validate market need? How can you sort of do that in the early stages? And that's, in a lot of cases, especially with the technical founders, you hear that a lot. We need to build it first to show it to our customers so that they will understand, what we're building. But that's bullshit, right? So you can actually do that without any code. You can actually start selling with a PowerPoint, and if you've hit a nerve, if you've hit, the right idea, you will get a meeting and you will get a POC, so like a proof of concept project. They might even help you finance it, right? So if something like that is interesting, right? if there's bad signals, like for example, if you can't get these meetings, of course, a lot of technical founders would say, well, but it's so much easier that I close myself into my little room and start coding, right? Because that's what I know. And a lot of people do that. And then, 2 years later, they exhaust their own resources, they start fundraising, and that's not the ideal case, right? It's way better if the company has shown some traction, some, basically business need before actually developing or, having just like a proof of concept type of a solution. Any other questions? Okay. So I'm going to continue with the third part, which is the, the Sportradar growth. I picked that because found it interesting, that sort of you guys also see what are, how a big company can actually grow and how fast it can grow, right? So maybe a little bit of a background. So Sportradar now is the biggest sport data provider in the world. When we joined forces with them, it wasn't like that. So, but the founder, Karsten, he was the founder of Bet and Win in Austria. So I don't know how many people know this, but this was in the 90s. He was actually pioneering the online sport betting. And he built that company, he IPO'd with that company. And then after a short sabbatical, he actually found two Norwegian founders who were building something that was, let's say, in a similar market, but way different than what Sportradar is. So they were crawling odds across different markets. And he had this insight from sport betting that, if, of course, mobile phones get adopted, and that would move sport betting into mobile phones, right? So you could do it live on a match or wherever you are, right? And that live, that meant that before sport, bookmakers, they were collecting their own data, scraping the web, or having their own scouts, because basically what you need was just the end result, so that what kind of match, you got the odds, and then basically you got the end result, so that you could result it, right? But with the live betting, you actually require really live odds or live data, right? And that means not just scores, but also all the other insights like corners, all the fouls, anything that you can bet on, and also dangerous attacks. So for example, if Sportradar flags on a certain match that there is a dangerous attack, that means that basically all the clients stop the betting immediately because somebody might be on the match betting on it, right, and predicting that there might be a goal, and that's why you stop it, and then you need to clear it as soon as possible, as soon as it's not dangerous, because that's still revenue trickling into sport books, right? So very valuable. So you need to be very critical about these signals. And looking at it now, Sportradar is now tracking almost 1 billion events annually across 34 sports, and working with almost 900 betting operators. So almost everybody works with Sportradar. And on the other side, also 500 media companies. So these are companies that could be either local newspapers, local telcos, but on the other side also big media companies like Google, Facebook, Twitter. They also buy data from Sportradar. And of course, there's what we call them rights holders. So sports leagues, they're usually partners. Because they then you do the agreements with them, how you then collect the data and so on. And currently, Sportradar is public. It did go public in 2021 at a valuation of 8 billion, but now after this correction, the valuation now is around 3.54, let's say. And what I thought would be interesting was actually showing the whole story of how this growth actually came to be. So we actually started with Sportradar in 2010, and we sort of sensed that they want to do a lot on the mobile side, and they didn't have local expertise, inside internal expertise, and they started working with us, and they said, well, we want you in, we want you as partners, and that's why we did sort of due diligence on both sides. So they did due diligence around our company, we did due diligence on Sportradar. They were really transparent, invited us to the management meetings, discussing all the issues, even before we actually said yes and sort of confirmed that we would go into this story. And this was, it was an interesting experience because basically you are there discussing, of course, all the opportunities, but also all the risks internally, right, with the management team. And then on the back of that, we decided to join. We basically, defined the valuation of Sportradar, the valuation of Klika, and we joined. So the three founders with the same stock level, and we got 1 out of 5, board seats, and from then on focused only on sport data. So from then on, we only started living and breathing sport data, even though before, we didn't even know that type of company existed. So that was 2011. Then.
Sorry,
Mhm.
what was Klika doing before?
So before we were, what I mentioned before is like a external innovation lab. So we like to work with other companies, with partners, looking at their business model and helping them with the technology. So basically we also, same as with any other companies, we started working with Sportradar, and we talked about different opportunities, what else is sort of where the market will move, what are the the things that we can actually build. And of course, in a minimal type of a way, so that we can first test this and then build the minimum viable product and then launch it, right? Yeah.
Excuse me, founders of Sportradar are also from Ljubljana, or?
No, so the main founder is Austrian, Karsten,
Yeah.
and there's 2 Norwegian guys. So yeah,
A better connection.
yeah. And so in the following year, basically, we got the first confirmation. Because initially when we sort of joined Sportradar, it didn't have any external investments, right? And in 2012, Sportradar then received the first investment. We were looking at American funds, well, not funds, but private equity funds, and European funds, and at the end decided for a European-based EQT. I don't know how many people know it, but it's a very reputable private equity fund. And they invested in the Sportradar at the valuation of 130 million. So that was almost 10 years ago, or more than 10 years ago. What's interesting is that with these types of private equity companies, they actually also help you with building the senior management, looking at their network, and sort of finding the right people that you're missing in the company. And then also helping you grow with that, right? And I have on parallel, so in red, also some of the things that are what our competitors were doing at that time. So as I mentioned, Sportradar was maybe 3rd or 4th sport data provider at that point. Perform was the big gorilla at that time. And they actually got listed at that point, got some funding out of that. And they acquired Running Ball, which was also a data collection company, which we wanted to acquire as well. And that was also one of the things why it was interesting for us, why we joined, is because we saw that Karsten, he really wanted to build a big company, the biggest sport data provider at that point. And when we were joining, we were talking about acquiring this company. Unfortunately, we were too late, and we needed to sort of, build a lot of the things in between to get, to be bigger than that group. Another thing that was interesting is that when you do, these expansions, so we sensed that US at one point will open for sport betting. So at that point, sport betting was not legal, was not allowed outside of Nevada, and I think New Jersey was already open at that time. But we sort of believed that at one point this will be a new market, right? So before there was just a couple of clients out of US, and we knew that could be like double our size, right? And that's why we acquired a US company, sport data provider, and a UK company doing what we call like left side sports, so rugby, cricket, and these types of sports. And we also launched in 2013 what we call a fraud detection system. So basically looking internally how the markets are moving, so the odds are moving, and then basically on top of that, predicting where something might be strange, right? So, and there is an internal team in Sportradar that's constantly monitoring these markets. When they see something odd happening, they focus on just that market. They make notes, they make the recordings, and then they pass this information to Europol and Interpol, and then they basically, do the whole sort of examination, criminal charges and so on. So we don't do anything after that. We also don't provide this type of information to bookmakers because they could harm each other. So basically, if somebody knew that something fishy is going on in some of the betting markets, then basically, one bookmaker could actually harm the other bookmaker by betting, on their betting site. So that's like a very closed off team inside Sportradar that's doing just that. And another thing that sort of, when we sort of started working in Sportradar, we identified that one of the big needs was, or problems, let's say, was that before Sportradar was collecting sport data and selling the what we call data feeds, so that the betting clients could actually ingest that into their sport books, but you don't get any insight into how big they are, how many, how much revenue they're making using that data. And that sort of bothered us a lot because basically you can only have pricing, on the speed, on the quantity of the data, and on the quality of the data. But everybody, requires fastest data. Of course, quality needs to be top notch. And, a lot of people, of course, require everything we have, right? So that's why you don't have a lot of flexibility in terms of pricing, right? Because you can't really say, I'm going to charge you more because you're getting more out of that data. And the first thing that we started out of Ljubljana was what we called hosted solutions and mobile solutions, which are sort of things that the bookmakers and all our clients actually hosted on their websites, and we at least got an insight through analytics how many people are visiting those sites, right? So how big are those clients, right? And this was the first step going a little bit more into the, closer to the transaction. Perform on the other side also acquired another data provider, getting bigger, got exclusive distribution rights for English Premier League. And that also created some problems for us. We, of course, then did a number of acquisitions which was purely operational, so like acquiring a Philippine operation. We also built a South American operation. So basically that you have a non-stop operation, 24/7 all around the world, covering all the global matches, right? Because if you think about it, it's almost like a financial market, right? So you need to be non-stop live because all the time there's some sports that's happening and there's some data that's happening. In 2014, we also started remote game server, which was the first type of a solution where you basically also got the transaction. So basically it's a different type of integration where basically you get, the actual transaction when somebody was placing a bet and you see the whole revenue and the whole profit of the bookmaker. So I'm gonna speed it up a little bit because I'm looking at the time. Interesting fact also that, the second fund of EQT bought out the first EQT fund that actually invested in us, and invested more money. In 15, we wanted to go even deeper with US. So basically we wanted to get to the NFL, NHL, and the bigger federations, even though sport betting was still not allowed, right? And that's why we actually accepted a US investment from Ted Leonsis, Mark Cuban, and Michael Jordan. And they invested in Sportradar under the promise that they will do the connections with the right federations and that we would actually, as a European sport data provider, maybe be perceived as more US and also get the rights, because before there was another company, Stats, that we also wanted to acquire that actually had those rights. But unfortunately, we did not manage to buy Stats, and that's why we went for the data deals, and we managed to do that. So not going a little bit deeper into those. But basically, it is important with the bigger with the bigger federations that you also get these distribution rights because you then have the right to distribute that data to the bookmakers, right? And in 15, out of Ljubljana, again, we launched a managed trading service, which is, a solution for bookmakers so that they don't need to do internal, risk management, but they can basically just offload that to Sportradar, just send all the traffic, all the bets to Sportradar. Sportradar then processes that and suggests whether they should accept this bet or not, and also changes the odds, because that's an internal team that's normally doing that. Even closing the markets if there's too much risk on one side and so on. I'm not going to go into too much detail, but for us, what was important is that was the first time when we could actually change the business model, where we could say, well, you don't need to pay. So usually it's between 100,000 to a couple of 100,000 of euros per month that bookmakers are paying for the data, for the videos, and for all the content that Sportradar provides. In this case, we could say, well, take it all, all the videos, all the data, everything, but we're going to do a profit sharing deal. So basically, we're going to grow with you, right? Because, the bookmaker cannot cheat you because all the transactions are going through you and you're actually balancing the books for them, right? And this was initially, interesting for smaller bookmakers. Now, I forgot how many trillions of dollars are flowing through that product. But now even the bigger bookmakers actually are seeing a benefit of actually just closing that internal operation and moving that to Sportradar. And this was, one of the things that, when we're now looking at, now Sportradar is public, and I can disclose that, because this was disclosed on the quarterly calls, that MTS, I think was more than 30% of EBITDA is actually already produced, using this product, which is, very interesting, getting from the point where this was like something where we sort of challenged ourselves, sort of innovated within our company to sort of, it was a replacement of our product, our other product, the feeds. But we said it's better that we disrupt ourselves than if somebody else would disrupt us, right? And now, Sportradar, because of that, it's in a much better position. So then a bunch of other, acquisitions and, NBA partnerships that happened. You're going to see that, these, especially American federations, they require more and more. So every couple of years when these deals are renewed, they require more and more money for that distribution deal. So, and we got, now I think the biggest competitor is Genius Sports. So basically it was a merger. It was interesting when we were sort of discussing whether we would buy it or not. At the end, we decided not to. Now it's another public company doing sport betting. We could say that it's like second biggest, still, I think, quarter of the size of Sportradar in terms of revenue. But, we had a chance to actually acquire it at one point. I'm just going to fast forward to 2018. At that point, US opened for sport betting. Everybody got big eyes because they said, well, now we're going to double our revenues. Of course, the valuation also exploded. And at that point, EQT decided to exit, and Canadian Pension Fund and another fund actually acquired 50% of Sportradar. And also myself and my partners and also the Norwegians, we exited at a 2.5 billion valuation. And so Genius Sports at that point was also acquired by a private equity company, and basically now we have two biggest companies now competing on the market. Then 2020 came, COVID. Interestingly, of course, if you don't follow sport data, you can't really predict. But of course, it was a big impact on sport data providers because there was not a lot of sports happening. So everything was closed, stadiums were closed. So basically, where do you get the data, and what do you sell, right? So there was still, of course, a lot of second, third sports happening. On the other side, this was interesting. In Ljubljana, they created a product called simulated reality. So, which means that basically they simulated, based on the statistics, they simulated how these matches, if they would happen, how they would happen. And bookmaker, and we call them punters, so people that bet actually bet on that. And Sportradar was also selling that data. And it was interesting that from concept to revenue, it was only 11 days. Because of course you have those clients, the clients of course also need the data, because for them, if they don't have the data, they don't have the revenue. So they needed something like that. So basically the team acted really, really fast and created quickly this product. And at that point, Ljubljana also became the biggest R&D center in the group. At that point, already employing 150 people. So going forward, last 2 years, you see that now these deals are getting already very ridiculous. So NBA deal that Sportradar signed before the IPO is already $1 billion worth. That's because Genius acquired NFL deal, also at $1 billion. So basically, we were the partner of NFL before, but then Genius came and offered a lot more money, a stupid amount of money, if you ask me. And publicly they were perceived as, okay, they're now the bigger challenger, right? So that's why Sportradar also needed to do something in order to go public, and they did a deal with the NBA, which I think it's much smarter because, NBA actually produces much more matches, and it's more interesting for live betting than NFL, which is actually just a very small amount of matches. And at that point, at the peak of the market, also Sportradar went public, and Michael Jordan sort of joined as a special advisor to the board. So now I can also disclose some of the revenue numbers because these are all public. So Sportradar is already at $500 million in 2021, and continuing with sort of acquisitions going into computer vision, machine learning, and so on. So last year grew already for also for 30%, and again a lot of acquisitions. So if Sportradar's valuation at that point, so after the IPO, it fell to 2 billion, so from 8 to 2 billion, and Genius also fell even more. So at that time, it was valued at 800 million. So still a ridiculous multiple based on the revenues, but interestingly, sort of comparing now two public companies going head to head. So now this year might be the first year when Sportradar is actually going to break the 1 billion revenue. And what I mentioned before, so not going to repeat that. So currently, it is the biggest sport data provider in the world, and Sportradar Ljubljana now employs 300 employees and growing nicely, and focusing a lot of the critical products are actually developed here in Ljubljana. So that was sort of, I hope that was interesting, sort of looking at how a company like that actually can grow. Again, this slide, so if you want to join the community, please do take this picture and fill out the form. I'm happy to talk to, I'm going to be here till 8. Happy to talk to you guys if you're building any interesting kind of stories. I want to hear ambitious stories. And I want to meet you guys. I want to get to know the Split ecosystem.
Quick introduction of the audience.
Yeah.
Which marketing solutions Sportradar?
Sorry, which?
Which marketing solutions you offer to your clients?
So Sportradar, which marketing solutions?
Yeah, one slide. Marketing functions.
I'm not sure I get the question. Aha, okay.
Marketing functions.
Yeah. So now these are more like, so when you go into the user management, going into, the insights of, personalizing sport betting and so what kind of offer do you actually offer to each and every user, right? So you go into the detail, the history of each and every better, punter, and then you can actually offer them and suggest them certain markets or not. Yeah. I hope that answers your question.
So were you working in the tech side of things all the time, or did you shift to business?
So I shifted, in that time I actually shifted to business. So when we joined Sportradar, we were about 45 people, and Sportradar was about 250. Even though a lot of, I know that the engineering was around, so Trondheim, which was at that point the biggest office, was around 70 people, and then there's up to 250. There was also lots of internal data scouts and so on, these other functions. And then myself personally, I actually focused more on one side on the management of the team. So I was the CEO of the Ljubljana, so managing director of Ljubljana, and also grew the company up to a little bit more than 100 people, and focusing on one side on the tech, and on the other side, for me, it's really interesting to to work on the business, on the product side. So more and more I actually focused on that. I was very quickly invited into the the M&A team. So I think it didn't even last a week after we signed all the papers with Sportradar that I was on a due diligence of another company that we looked into. Sportradar usually looks at 20, 30, 40 different companies per year. And there was a team that I was actually going through that and looking at all the different companies, opportunities, whether we should invest, whether we should buy them, and so on. And this was very interesting learning for me because looking at from a bigger company, understanding sort of the strategic direction, and also looking at it how this M&A might actually fit into the bigger picture.
Their full potential, like what is the reason that some companies do success, become global success, and something like that.
Okay, so what are the typical reasons that company startups don't grow as planned, let's say? Yeah. Well, interestingly, the biggest risks are founders. So either, at the end of the day, people get tired, maybe the growth stagnates. And then, after working for so many years, then, people want to start some other companies, right? So, and that's why we always suggest that you do what we call reverse vesting. So when you start a company, it's always good that, especially after you get an investment, that you basically say, okay, we all are on the same boat, and we need to earn our shares again, right? So, and that sort of also, it helps you remove the risk that if somebody actually, in the second, third year gives up, they're not in as founders, right? That you have a way to actually get that share to somebody else that might take up their space. So that's one, of course. The other very obvious one is the product risk, so market risk. So if you see that, people believe that there's going to be, that there is a market, that there is a niche for them, for that product, but at the end it never materializes, right? And that might be due a number of reasons. One, because it's true, right? So nobody really needs, or there's not a big market for that product. Or on the other side, we still see that there's, the whole CEE region, so Central and Eastern Europe, there's a lot of technical talent, but there's still a lack of sales talent, right? So especially B2B sales is really hard. And then if you have a US market, you need to find a US salesperson, which is always risky, right? So, and that's, these are sort of the top risks that we see. And how do we deal with that? So basically, we suggest to the founders how you structure everything across the, when you're building a company, when you receive an investment, and on the other side, how you can validate as soon as possible. So we even work with founders even 6 months before we actually invest, but we work with them to see how it is working with these founders, to see how they react to, to feedback, how fast they are. Does it take a month before they reply to you on, your challenge, or are they quick and aggressive, right? And of course, ambition. That's another thing, right? So you need to really aim high to actually build a big company, right? It does not happen, by chance.
Do you have a sweet spot for the amount of equity you take for a seed, and do you do follow-up?
Sure. So, as mentioned before, so we usually do on average, the pre-seed ticket is on average 200K, but that could vary between 100K to 500K, right? And at that point, we take 10 to 15%. So we're usually on an angel level, because how we work is that our personal network and the network of our LPs then basically say, look, I don't invest personally anymore. Here's a fund that I invest through. Talk to the guys, and then we basically do that angel round, right? So it's healthy that you don't give out more than 15, max 20%, let's say. And then following later with the seed round, which averages around $1 million, we then either retain that and might even increase the percentage. Sometimes if the founders are senior, so that they might have their own funds, and they actually went through the pre-seed stage funding themselves because they earned that from their own exits, then basically join in the seed round, usually investing at $500,000 to $1 million, but on average around $1 million. Again, 10-15%.
And country of registration company does not matter?
Well, normally, yeah, it does not matter. We focus more on where the founders are from. And what we notice is that we invest a lot in diaspora as well. So people that moved in the US or wherever, they're usually more ambitious. They moved from here. This is usually not easy. And also they are exposed to bigger challenges, right? There's a lot of people that actually worked in Amazon, in Facebook, or in Uber, for example, and they saw an interesting opportunity there, and then they moved back. They built, so basically they started a company, established it in US or in UK, and then they established a subsidiary which is R&D, and that's sort of the typical setup that we also suggest. We also see from the the analysis that we do on the market that, let me think, so I think it's 85% of the capital that was invested in the region was actually invested in companies that are not registered here locally. That means Slovenia, Croatia, Serbia, right? But they are founders that are from this region. So usually it's good that you sort of talk to somebody that went through before the first investment, because after you receive the first investment, the company already has some paper value, right? So you cannot go below that, the value that you received, or even the valuation that you sort of showed at that point. And usually the companies need to follow the market. The market is never here. So usually these companies, if they want to be global, they don't sell in the region. So that's why you follow the customers, which is usually US, UK, or Western Europe. And when you do that, when you move the company, it can be tricky because you already have a valuable company here, and it's harder to do the flip, right? But at the end of the day, you're probably going to be requiring, money from foreign VCs, and for them it's so much easier. They're used to, the laws that they know, the rules that they know. It's not impossible, so there's still, 15% of that capital that was invested locally. A lot of it is Rimac, and even Rimac, I think he said that he wouldn't do it again, so he wouldn't keep it here locally. So, but he wanted to sort of showcase, but at the end saw that even having the ESOP structure, so sort of giving out the equity to the employees, it's harder to do with the local DO structure.
Okay.
How many hours a day you work nowadays after an exit?
So, well, this is now a full-time thing. So there's 8 of us in the team, and we live and breathe that. So basically non-stop. So it's still, of course, personally, a small amount of time is, focused on managing my other investments. And, usually when you look at the portfolio, you should not invest more than 5, maybe 10%, even if you work in that, maybe 10% of your wealth into startups, because it's a risky investment. So that's why, the 90-95% of the investments, which are, for me at least, boring, but, you still need to do it. So that keeps maybe, 5% of my time. but everything else is focused on this.